Welcome to Money Talks, the ultimate financial news upload, where knowledge meets empowerment. Join the money getter duo, CC and Cecil B, as we unravel the mysteries of finance Monday through Friday at 8 p.m. From the latest in fintech, cryptocurrencies, real estate, electric vehicles, IPOs, and Wall Street, to the rise of robotics and AI, we cover it all. So tune in as we share in the spotlight on how Black entertainers and creators alike are shaping finance and tackling IPOs, giving you the information you need to thrive in today's economy. This is Money Talks. Good evening. Today is Monday, April 14th, and you're watching Money Talks. I'm your host, Cecil B. Money Getter, and first up in trending news, steady through the storm. 3 big name stocks for these tough and tricky trade times. Well, after a week of massive market losses tied to Team Trump's polarizing tariff policy, U.S. consumers are understandably worried. As of April 10th, the S&P 500 index was down 2.20% over the past 5 trading days, including a big pop over the 1,400 points on April 9th and a 9.52% gain for the SPX, the index's 10th biggest day ever. That hasn't pacified investors or consumers, even as other economic markets are trending positive. Exhibit A is inflation, with the U.S. Consumer Price Index falling by 0.1% in March, the lowest monthly rating since COVID-19 pandemic. Yet, the widely used University of Michigan Consumer Sentiment February survey showed consumer confidence falling to a 29-month low, a signal that U.S. households are struggling right now. However, some U.S. consumer sectors have proved immune to the worst of tariff hikes. These 3 U.S. consumer brands in particular are well positioned to prosper during these trade wars, while consumers are looking for stabilizing consumer stocks. The March inflation number was nice, but don't get used to it, said Greg McBride, chief financial analyst at Bankrate. The headline consumer price index for March decreased, aided by lower gasoline prices, and the annual increase in the core rate posted a 4-year low of 2.8%, which shows how tough it has been for household budgets during that time. But consumers, businesses, and even the Federal Reserve are bracing for higher prices in the months ahead, with everything from Buicks to Barbie dolls rising in price during the trade wars. And even with President Trump's April 9th call to pause the tariff hikes, consumers are scrambling for cover and spending less on goods. That's bad news for consumer stocks, as the S&P 500 Consumer Staples Index is only up 2.21% for the year to date and down 3.27% over the past 5 days. New loan and bond insurance has come to a halt, as have M&A and IPOs, as nobody wants to go to market right now given all the uncertainty, said John Braingardner, who is the chief executive editor at Debwire. Air freight companies, airline retailers importing goods from China, and Indian pharmaceutical companies are among those we've written recently that are trading down following the latest tariff activity. The tariff hikes haven't affected some U.S. consumer sectors much, though. Retailers, warehouses, and consumer staples companies are good examples of some sectors that are actually holding up fine despite the issues, said Fabio Ruggieri, founder and CEO of Mentor Q, a trade tech company that specializes in developing advanced quantitative models for active investors. They sell essential items that are less exposed to tariff-driven price swings. That makes them more resilient in these kinds of markets. All about geography right now when tracking consumer stocks. While global consumer brands are navigating these increased costs, U.S.-focused sectors that have already localized their sourcing are feeling less pain and in some cases gaining ground, as competitors are still trying to figure out what to do next. And up next, in the latest market hustles and hacks, what if you could earn profits in seconds with zero upfront capital? Would you take advantage of said opportunity? Imagine you could borrow $1 million instantly with no collateral. The whole thing would happen anonymously and you wouldn't need to assume liability for the loan. Sounds crazy? That, in a nutshell, is how flash loans work. The financial demonoid of DeFi, they're perfectly normal and growing in popularity, not least for their facility in making profitable arbitrage trades. You'll need a big enough position to make it worthwhile, but the barriers to entry are low. No need for institutional backing or SEC registration. With a bit of effort and the right tools, anyone can take part. At a glance, flash loans are trustless DeFi transactions that allow users to borrow funds without collateral. Traders can use them to identify arbitrage opportunities across decentralized exchanges or DEXs. Access a flash loan provider, liquidity pool provider like Aave, you'll need to set up smart contract compatible its protocol. There are some barriers. Technical complexity can be off-putting and opportunities arise from tiny price differentials. You'll need knowledge, tools, and the capability to act fast. But are flash loans, you ask? Flash loans enable DeFi users to borrow cryptocurrencies from an on-chain liquidity pool. There's no obligation to complete and no need to provide a security. The principal just needs to be returned to the pool within the same blockchain transactions, plus a fee. If the borrower fails to do that, the transaction is completely reverted. Risk of default is zero. Users gain greater access to assets without undermining the solvency of the on-chain liquidity pool. Practices unthinkable in traditional finance are a daily reality in DeFi. And for retail traders, that creates opportunities. First launched on the Aave DeFi protocol in 2020, platforms including DYDX, Equalizer Finance, Uniswap, SushiSwap, DeFi Saver have all moved to offer flash loan capability. How does flash loan arbitrage work, you ask? Blockchain transactions typically resolve in a few seconds, so the use cases for flash loans must be equally quick. Arbitrage traders are one of the most popular. Flash loan arbitrage leverages price discrepancies for the same crypto asset across different decentralized exchanges. For example, say the price of Ethereum on Uniswap is $3,000, but on SushiSwap is trading for around $3,000.01. That creates an opportunity to buy ETH at a lower price and sell it at a higher price. But you'll have to act fast. Arbitrage depends on micro price differentials, and opportunities in the crypto market typically last only a few seconds. Trades require significant capital and fast execution to achieve a successful outcome. Flash loans can provide the capital, and they come with built-in risk mitigation. If you can't repay the in full plus fee by the end of the blockchain transaction, everything reverts instantly. Think of them like Schrodinger's loan. If they generate a profit, they're real. If they don't, they never happen. Get in the comments. Let me know what you think and how you feel.
You just finished an episode of Money Talks. Let me know how you're feeling in the comments below, and make sure to check out our other YouTube channel, 734 Listening Library for self-help books and shorts. See you at the top. Holla!